Hello, friends. Today we are going to learn about best Forex trading strategies. Scalping, swing trading, day trading, and position trading are four primary strategies used in Forex trading, each differing in time frame, approach, and risk profile. Scalping is a short-term strategy that focuses on making numerous trades within minutes or even seconds, capitalizing on small price movements. It requires traders to closely monitor the market, often relying on technical indicators such as moving averages, Bollinger Bands, or RSI to identify microtrends. Scalping demands rapid decision-making, fast execution platforms, and tight stop-loss orders to manage risk, as the profit per trade is minimal, typically only a few pips. The high frequency of trades can lead to substantial cumulative gains, but also involves significant transaction costs and psychological strain due to the intensity of monitoring required. Day trading, in contrast, involves opening and closing trades within the same day to avoid overnight market risks. Day traders aim to exploit intraday price movements, often influenced by technical analysis tools like trend lines, MACD and VWAP, as well as economic news releases that cause short-term volatility. This strategy requires discipline, as positions must be closed before the end of the trading day. The profit per trade in day trading is usually larger than in scalping, ranging from 10 to 50 pips, but the frequency of trades is lower. Day trading strikes a balance between the rapid pace of scalping and the longer horizons of swing trading, requiring moderate time commitment and market analysis skills. Swing trading is a medium-term approach that targets price swings over several days or weeks. Unlike scalping and day trading, swing trading allows traders to capitalize on broader market movements, often using a combination of technical indicators like Fibonacci retracements, support and resistance levels, and moving averages to identify entry and exit points. Swing traders may also incorporate fundamental analysis, considering factors such as interest rate trends and economic indicators. The profit per trade is significantly larger, often between 50 and 200 pips, but positions are subject to overnight and weekend market risks. This strategy is less time-intensive, as trades do not require constant monitoring, making it suitable for those who cannot dedicate their full day to trading. Position trading is a long-term strategy that involves holding trades for weeks, months, or even years, aiming to benefit from major market trends. This approach relies heavily on fundamental analysis, including geopolitical developments, central bank policies, and macroeconomic trends, though technical analysis of long-term charts can also play a role. Position traders are less concerned with short-term fluctuations and more focused on capturing large price movements. This strategy requires substantial capital to withstand market volatility and patience to allow trades to play out over extended periods. The profit potential is the highest among the four strategies, but it also involves the greatest exposure to market risks and opportunity costs. Choosing the right strategy depends on individual factors such as risk tolerance, time availability, trading capital, and psychological comfort with different levels of market engagement. Scalping and day trading suit active, hands-on traders who thrive in high-pressure environments, while swing and position trading are better suited for those who prefer a more relaxed, longer-term approach. Risk management, including appropriate position sizing, stop-loss orders, and diversification, is critical across all strategies to ensure sustainable profitability. Understanding market conditions and adapting the chosen strategy accordingly is also essential, as different methods perform better under specific volatility and trend scenarios. Mastery of any strategy requires consistent practice, education, and a disciplined approach to trading. Make sure you like this video and subscribe the channel before you go. Thanks for watching.